topic on marginal costing, also called as break-even analysis. This concept is important for decision making. We are talking about costing. Costing involves the calculation of cost of production for various purposes. And in this case, we are going to use the information that is derived out of historical costing records in order to plan for the future. So what is marginal costing? Now in essence, marginal refers to variable cost. Now we all know that there are two types of cost, variable cost and fixed cost. Marginal cost refers to the cost of producing one additional unit, and this analysis of cost enables us to calculate or find out at what point of time or how many units needs to be produced by a firm if it wants to break even. So we are going to discuss the concept of break-even analysis. What is break-even analysis? Break-even analysis or break-even point refers to the number of units that need to be sold by an organization in order to meet total cost. In other words, break-even point is that point where total revenue is equal to total cost. It is calculated as follows. Now, when we go to the breakup of cost, we see that total sales is equal to total cost plus profit. Total cost plus profit. Now we have the breakup of total cost. Total cost is equal to variable cost or marginal cost plus fixed cost plus profit. So we know that the classification of total cost is variable cost plus fixed cost. So now the actual cost bifurcation takes place like this. So we have a concept arising from this: sales minus variable cost. Sales minus variable cost is equal to fixed cost plus profit. So now what have we done? We have brought the variable cost to this side of the equation. We have sales minus variable cost, which is equal to fixed cost plus profit. This is called as contribution. Contribution is quite a familiar term and it's discussed many times. This is contribution. Now why are we discussing contribution? Contribution is very important when we come to decision making. A lot of decisions with regard to how many units to produce, make or buy decisions, borrow or expand capacity or continue the same, plant capacity that is needs to be decreased or increased. All those decisions are made by taking into account this contribution. So this contribution is required even to calculate break-even point. So with the help of contribution, we can calculate break-even point as follows. Break-even point or BEP can be defined in units or in terms of rupee sales. Break-even point in units is equal to total fixed cost. Total fixed cost divided by contribution per unit. Divided by contribution per unit. This will help us to find out how many units a firm has to produce to enter into the no profit, no loss area. It is the minimum required for a firm to produce so that the firm does not have any losses. So that is the concept of break-even. Now if we want to describe this in terms of rupee value, then BEP sales value